Once upon a time, my grandma called me and asked, "Greg, how much money can I expect to make if I put all my money in Apple?" And I said, Grandma, that's a really hard question. Well, if you want to talk about that question, that's what we're going to do in this video. So hang out and we'll get into it. Investors generally have an idea of how much they want to earn on their investment. Maybe not to the basis point, which by the way is 1/100%, but at least a rough idea. The returns investors expect to make depend upon the level of risk associated with the investment opportunity. Because idiosyncratic risk can be diversified away, investors should only expect to earn compensation for the systematic risk they bear. The level of systematic risk a firm bears is a function of how much their returns, earnings, and cash flows vary in different states of the economy. Take BMW, for example. When the economy is doing well, employment is high, and people are earning good annual bonus checks, more people will want to upgrade their car. BMW will perform very well in a good economy. But what happens to them in a recession? When people are losing their jobs, there are no bonus checks this year, and the stock market is dropping, people are less likely to have extra money to spend on a significant car upgrade. So, the stock struggles in a recession. BMW bears a lot of systematic risk then. Now consider Walmart. If people get big bonuses this year, surely some of it will be spent at Walmart, but some of it will be spent at BMW on expensive vacations or on cell phone upgrades. As such, Walmart does better in an economic boom cycle, but not as much better as BMW does. What happens to Walmart in a recession? They probably sell fewer TVs, furniture, and steak, but most people keep buying deodorant, toilet paper, toothpaste, and getting their prescriptions filled. At least we hope people are still buying those things even in a recession. By comparison then, Walmart is a much lower risk proposition than BMW would be. So BMW investors would want greater compensation for their exposure. Another aspect of systematic exposure to consider is the level of debt the company carries. If a company has more debt than their peers, the contractually obligated debt payments will have to be made even in a recession. This leaves even less for the stockholders and increases the chance that the company could go bankrupt. If a company is sitting on a pile of excess cash, it functions like negative debt. They will be able to make payments for a while even if their sales drop. All else equal, carrying more debt increases a company's macroeconomic exposure. You might wonder then how systematic exposure and investor expectations are linked. The relationship is a linear one, which we can estimate using regression analysis. When we regress a company's stock returns on those of the broader market, we can see if the company is more volatile or less volatile than the other firms an investor could buy shares in. We call this measure of a firm's systematic risk its beta, from the regression equation. Once we know a firm's beta, we can plug it into the capital asset pricing model, or CAPM, to estimate the company's cost of equity, or the return that the shareholders should expect for having invested in a company that bears this level of systematic risk. CAPM says that the cost of equity is equal to the risk-free rate plus beta times the market risk premium, which just means how much more than the treasury securities stocks should yield. If a company has more debt, it will have a higher beta, and thus a higher economic exposure, and thus higher required rate of return for the stockholders.